Good afternoon, everybody. Welcome back to another Tuesday afternoon episode of Nadex Binaries with Path Trading Partners. Thanks again for you guys, to Nadex for having us, and thanks to you guys for being here. This is a fun subject for us, and it's an interesting subject for us, and I'm going to talk about this a little bit before I go into the risk statement, and I'll probably just gloss over who we are and our bios and stuff, and you guys can read those potentially in the recording. But trader psychology is one of these things that people talk about as if they know something about it, and it's usually all the same stuff once you get into it. It's all the greed and fear and control your emotions and all these just sort of cliched things that are really, really easy to say and extremely difficult, if not impossible, to do. So when you talk about trader psychology and you talk about how to control the things that go into this whole psychology field, there really is one and only one solution to that, and that's your trading plan. And this is something that is so difficult for people to get their minds around, and it makes a short process longer, and it seems to scare people away from doing the only thing that could potentially fix some of these emotional problems that most, if not all, traders go through. So when people talk about trading psychology and they start talking about accepting losses and things like that, it's, again, one of those things that's so much easier said than done. And what we're going to talk about in this webinar is what is actually going on behind what everybody else calls trader psychology. Just in the same way that when we teach price action, we try to teach pure price action, and then we sort of dive around what's actually going on behind candles and behind price action. We're going to show you what's going on in your brain and why you actually act this way and why you shouldn't feel ashamed that you act this way. Because, again, 90% of us, if not 95% of us, do. These are normal human feelings and normal human reactions that come about, and it's not so simple as to read a book or watch a webinar about trader psychology. You actually have to take actions to fix these things because you're fighting against something called emotion that you can't really fight. Emotion is spontaneous. You don't sit there when you're going to cry over something and say, I think I'm going to cry right now. You don't do that. It just happens. When something makes you laugh, you're not like, wow, that's really funny. Hang on one second. I have to prepare a laugh. These are emotions, and these things are spontaneous. So controlling emotions, as you'll see in this presentation, is not really what it's all about. There are things you can do to affect change. Okay? There are things you can do to affect change. And we hope that we'll be able to convince you through this webinar that taking these actions can actually fix this trader psychology problem that probably each and every one of you, if you don't battle it every day, you have battled it in the past and most likely will battle it in the future. So pay attention to every part of this because we're going to go about sort of in a way that we teach where we explain it and then we explain the solution to it. Okay, and then hopefully it'll become more clear as I go through this. So this is the cure for your bad brain. This is trader psychology and your plan. This is essentially how to become a better trader. It's really what this is. This presentation is for information purposes only and does not constitute investment advice nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. I said I'm going to kind of glance over this stuff, and I think I will. If you've been in our webinars before, I've gone through who we are. We're essentially a trading and education firm, and our mission was to form a trading firm that educates, supports, and backs traders with seed capital who are committed to probabilities, discipline, and long-term trading success. And this is achieved by following the correct path. Our name comes from what we're going to teach you guys here. Okay, that's actually where the name of our firm comes from. We are not high-frequency traders, and we are not day traders. We are a firm that believes in a long-term success in trading, covering time frames dictated to us by products, markets, and price action. Again, our name comes from what we're about to show you guys. So I hope I don't lose any of you guys as we go through this, because we're going to go into things that you probably haven't heard before, and they're simply human facts. And then you can hopefully move forward with your trading career, not being embarrassed when you do something that, I will say, you do something stupid, because that's what happens. I do stupid things too in trading. You'll do something stupid and you'll blame your greed, you'll blame your fear, but there really is a solution, and down the road I want you to blame you not taking the actions that we're going to show you here. This is who Mike is. Again, if you haven't heard before, I think the most important thing you have to know about Mike is his career as a strategy and development consultant to hedge funds. He's been doing this a year longer than me. We've been teaching and mentoring traders about the same amount of time. We became partners about 6 years ago, 6, 7 years ago, something like that. It's felt like 6 minutes underwater. I mean, it's been awful. But Mike traded in Chicago, New York, and Switzerland. His work as a strategy and development consultant is essentially to break hedge fund models once they've made them. They create models and they call Mike in to essentially break them, tell them what's wrong with them. So he's the current head of technology and trading system development for Path Trading Partners. And this is me. I don't care. You guys can read this later. There's a recording if you're interested in reading all this. Just take a look at it later. You know, hang on. Before I move on, one of the things, so I do I'm a guest analyst all the time on TV, right? I did Bloomberg last week, CNBC. I was in CNBC Taiwan on Friday morning. One of the things that they don't know on TV, that when I do these interviews, is Mike and I will look at our price action strategies and our charts, and we'll figure out what the probability of the move of whatever particular thing they want me to talk about is, and then I will go into the fundamental side and figure out what might make the market move that way, and that's where I get my opinion from. Okay, and this is, again, most of that comes from what you're going to learn in this particular webinar. We talk about the what and the why, and we'll cover the what later on in this presentation. But I get my why, I derive it from the what, and that'll make sense later in the presentation. I look at what's going to happen, or what I think has a high probability of happening in a particular market, and then I go, okay, what could make that happen? Like, why would that happen in this particular market? And that's what I go say on TV. And the recent oil bottom that Mike and I called out, I said it on CNBC when oil was about $27 that it was the bottom, and they keep emailing me saying how great that was, and it was just price action. It really was. But I came up with fundamental reasons behind it. All right, and that's following some of the plans and some of the steps that we're going to show you here.
And you're revealing all the secrets.
Not all of them. Not all.
Close to all of them.
This is going to be a lot looser of a webinar because I can't keep Mike quiet during these. During this particular subject, he just blurts stuff out. That's his emotion, and I just simply can't control it. Can you mute, please? Thank you. So this is what most traders think success looks like. Okay, you start out, you get a book, a DVD, you buy a course, whatever, you learn a strategy, and you walk away with so much money that it's falling out of your arms, right? That's what most people think success looks like. And they think it's a straight line like that, but the fact of the matter is, this is what most people experience, okay? They experience some ups, some downs, some sideways movements, some dropping back, some quitting, some restarting, all the way down to basically emptying their account. That's really what most potential traders, I should say, experience, is more this image than this one, right? And this is a fact, and there's a lot of reasons behind that. One of the reasons was summed up by a student of ours about 6 or 7 years ago named Dave Barnett. He wrote this and sent this to us, and I've read this probably 1,000 times in webinars, in live events, in all kinds of places. But he wrote this up when we were doing a live event in Chicago. He came in from the UK and went to our live event, and he handed this to us. And I thought this was great, and we've been using it ever since. He called it a true trader's outlook. Losing trades are the complementary probabilities that complete the winning trades. One cannot exist without the other. Therefore, until you accept your losses or your losing trades, you cannot embrace your winning trades. Failure to accept all probabilities leads to skewed results. Meaning, you take the losing trades, then out of fear, you stay out of the market and you miss the winning trades. This cycle perpetuates until you blame the strategy and discard it. And then you then move on to the next strategy where you start a new cycle of failure. This is probably one of the most concise explanations of a lot of traders' psychological issues that I've ever seen, and it was written by an aspiring trader, an aspiring student of ours, who ended up becoming very successful in trading. That's the only thing he does now. He was actually in a bank's back office doing IT, and he ended up becoming a trader for himself. But he's allowed us to use this. He knows we use it. He's a fantastic guy, and he wrote this, again, about 6 or 7 years ago, and it's so concise, especially the bottom half of it. Failure to accept all probabilities leads to skewed results. You take the losing trades, then you get nervous, and you stay out of the market for fear that another loser is coming, and that one inevitably is a winner. Okay, it's not actually Murphy's Law. It's Dave Barnett's law. It happens all the time. And this cycle perpetuates, and then you go, you know what, this strategy doesn't work. When the truth is, the strategy didn't produce winning trades each time you traded it, because you weren't actually necessarily following the strategy to the letter, which again will come up later in this particular webinar. But this is something I'd like you guys to all take a screenshot of. If you're not doing it right now, potentially go to nadex.com when this recording is up and take a screenshot of that with Nadex's permission, I hope. And keep this around, because this will play into some of the other things we're going to talk about. The fact of the matter is it's just too easy to become a trader. You just open up an account and call yourself a trader. That's it. You take a trade, and now you're a trader. What other profession can you start that easily? Certainly not one that you can kind of make the kind of money you can as a trader, right? Becoming a doctor or an engineer or an electrician or a plumber requires time, study, practice, apprenticeships, licensing, all kinds of things. Trading is actually a challenging career, and it's going to test you in many ways. And as a trader, you need to take every possible action which can contribute to your success. This is one of the shortcomings of a lot of people is, look, anyone will take your money when you go to open an account. Okay? If you have money you want to put in a trading account and you can't find someone to take it, call me and I bet you I can. There's a lot of bad people out there in bad companies, Nadex not being one of them, which is one of the reasons we associate with them, that will take your money and allow you to lose it and charge their fees, and that's that. Okay? It's simply just too easy to become a trader. And what makes you a trader? Just because you took a trade, you're now a trader? If I go, after this webinar, if I go cook some pasta, am I a chef? I mean, I'm not. So I think people have unrealistic expectations, and what most people focus on when they decide to become a trader is entry and exit rules. Okay, where do I get in and where? Just tell me where I get in and where I get out, and then I'll be a trader. Then I'll know what I'm doing. When there are tens of thousands of different situations and circumstances that can't necessarily be covered simply by entry and exit rules. So what's the best thing to do? Well, the best thing to do is to create a set of rules within a strategy, whether it's yours or somebody else's, that essentially make up your trading plan. Traders need to focus on your trading plan. The trading plan provides a solid foundation from which to begin your trading career. It is really the most important part of becoming a trader, is your trading plan. And it is the thing that fixes a lot of these problems. I'm going to turn this over to Mike now for a minute, and I promise you I will be back because we're having a good time kind of picking on each other here. So Mike, I'm going to go ahead and give you the keyboard and mouse.
Thank you, Bob. Welcome, everybody. Thank you for that great introduction, Bob, and the wonderful story to lead this off and revealing all your secrets on TV. So let's take this a step further. You can't hit a target you can't see, and you cannot see a target you do not have. That is really important. Let's take this into two parts. You can't hit a target you can't see. If you can't see your target, it's going to be very hard to hit it. You're just going to be firing at this in this example, arrows randomly. If you were blindfolded and spun around and then you don't know where the target is, you're just going to be firing off out and hoping you're going to hit it, and you're probably not going to hit your target. And if you do not even if you don't even have a target, you cannot see it. You know, if there's not even a target out there for you to hit, how are you even going to imagine to hit it? So, how are we going to deal with these kind of things? Well, we first have to ask, what is the target? Your trading plan is the target, or a trading plan. That is the first target a trader should be attempting to hit. The trading plan will provide you with the necessary feedback, and we'll get in later on in this webinar, we'll get into how you can get that feedback and how you can establish a feedback loop. As you grow as a trader, the plan will grow with you. It is not a static document. Most people say, oh, it's like a business plan. No, it's like a trading plan. It might initially have a component of a business plan, but it also has your strategies, psychology aspects, everything about your trading career, and you as a trader are going to grow over time, and therefore your plan will grow with you. It's not something you write out, file in the drawer, and say, okay, I did the trading plan, check. It's a tool to help you. It is the target. Writing a trading plan provides you with a roadmap from which to keep you accountable. It's something you will reference constantly. You cannot simply do it in your head. That is not going to work. It's something that has to be written down. Putting it in writing is the first step to becoming a successful trader. It's writing it down, and then, as I mentioned before, it's not just writing it down and putting it in a drawer. It's writing it down and using it as part of a feedback mechanism and growing with it and modifying it so it can help you as a trader. Let's look at that trading pyramid, okay? I just went over the trading plan, which is the solid foundation, all right? That is the basis from which everything else should be developed. And initially, if you're just starting out, your trading plan is going to be a little more sparse, but it's good to have it. You need a blueprint. You need a foundation from which to build your career, and you're going to be adding to that foundation over time, but if you don't even establish that foundation, you have nothing really to build on. Next thing is risk management. Why is risk management so important? Because if you don't have risk management, you can literally blow up your account in a day. If you don't know how to manage risk, if you don't take the proper steps to manage risk, if you don't understand reward versus risk and everything else, then it's going to be very hard to remain as a trader. So that's built on top of your trading plan. Trading psychology. That's another thing, that it's not a one-time deal. Again, your trading plan is not a one-time deal. Risk management is not a one-time deal. Trading psychology happens constantly. This is starting to build up the pyramid. You notice I don't have anything about entries and exits there or strategies. What most people are focused on is the next component. That is actually the last component we should be focused on, the entry and exit rules and strategies. Because if you don't put a proper plan in place, you'll have your entry and exit rules and your strategies in that plan. If you don't have proper risk management, and then if you don't use proper trading psychology and feedback loops and know how to evolve as a trader and know how to eliminate actions that aren't supportive of your trading outcome and reinforce actions that are, it doesn't matter all the entry and exit rules, because you can always learn a new strategy. You can always learn a new system. The problem is most people just focus on the entry and exit rules. Our brain fools us. Our brains are not generally our friend when it comes to trading. I'm sure some of you have already realized that. I've been in this industry for 25 years, and I realized that a number of years ago that my brain wasn't actually helping me. The way I was wired wasn't helping me. Trading involves significant risk and reward, which triggers the basic lizard brain. And we'll get into what the basic lizard brain is in a little bit. The lizard brain goes after rewards and avoids loss at all costs. Think about that. It goes after rewards, it chases after something, and avoids the big stick. It goes after the carrot and avoids avoids the stick. It doesn't to lose. It's part of the thing that is hardwired in all of us. We naturally don't like to lose. This can distort what you see and how you react to the markets while trading. Well, what do you mean it distorts what you see? Let's go into that aspect now. Some of the rules of the brain. The brain categorizes things into three main functions. It deletes. It removes information that it thinks is not important to the outcome. You can only hold a certain amount of things in conscious memory. You are bombarded, and people have a lot of different aspects. There's 11 million bits of information hit your unconscious per second, 40 million bits, which, different people who study the brain have come up with different amounts. But really, you only are conscious of a little bit. Like, some of you are probably sitting in a chair right now, and if I mention, you notice a feeling of the chair on your back or your legs. You were blocking out that information until I said it. Do you know the temperature of the room? Are you hot or cold? Some of you weren't even looking at that aspect. Do you notice your breathing right now? Well, until I said it, your brain was deleting it out because it was not important to the outcome. Focusing on this presentation is important to your outcome because, hey, it's going to help me be a better trader. So your brain's deleting other superfluous information, but you don't always know what it's deleting. Keep that in mind. Distorts. Your brain wants to change information you perceive to fit in with your current belief system. All right, it wants to reinforce what you already believe, and it's going to say, okay, you don't believe this, it doesn't fit into the category, so then why should I bring it to your conscious mind? Why should I present this information if it's not going to be what really reinforces your current mindset? I bet you've just seen that in trading already, where you already had a mindset that the market's going to go up. Whatever, crude's going to go up. If you aren't following a system and you just think, hey, crude's going to go up, what your brain's going to try to do is delete all the information or distort the information to say, hey, let's only present to the trader the information that already supports the case that crude is going up. So between deleting and distorting, you can block out stuff or change what you're actually seeing to support your belief system. Number 3 is generalizes. Generalizes means it lumps groups of information together to categorize the information. Why does it do that? Again, you're bombarded with so much information. Imagine if you had to relearn what a light switch is every time you walked in a room. Or we've all seen doorknobs, and there's many different styles of doorknobs, okay? Your brain lumps pretty much door handles, doorknobs, everything together in a category in your brain that says, okay, this is going to open or close or lock or unlock a door. Every time you go to a new door and you see a handle that's slightly different, you don't have to relearn what it does. The way the brain does that is it generalizes information. The brain does this because it's hit with so much information per second, it has to narrow down what the conscious mind focuses on at any given moment. That is why it's doing this. It's first trying to reinforce and sort of, hey, I'm going to only present it with information it wants, and it can't actually present all the information, else you couldn't get out of bed each day. You couldn't do anything because you'd be bombarded with so much information you could not function. So let's get into a quick video now that's going to we're going to show a couple videos in these presentations that are going to help you understand what the brain's doing in a couple different ways. So Bob's going to play this video for us, and then we're going to see, and we're going to discuss it afterwards.
Watch what happens as the unsuspecting pedestrian provides directions. The young man on the left is one of the experimenters. He has approached the white-haired man and asked for directions. Watch closely as two people carrying a door pass between them, and the first experimenter is replaced by someone else. like many of the people in this study, the pedestrian was entirely unaware that he was talking to a different person. Approximately 50% of the people approached in this study didn't notice when the person they were talking to was replaced by someone else. This study was among the first to demonstrate that change blindness can occur outside of the laboratory. This video is from research by Daniel Simons and Daniel Levin and is copyrighted. It is available for use in talks, training, and teaching on DVDs from VisCog Productions. Learn more at theinvisiblegorilla.com.
Okay, so that's very important. Almost 50% of the people didn't notice the original person they were giving directions to changed. Well, why not? Well, they might have been so focused on giving directions that their brain actually deleted or distorted that information because they didn't think that the person they were talking to was maybe that important, or they didn't have to pay attention to him because they just wanted to get directions. They were more focused on giving correct directions. So they didn't even realize that the person became a completely different person, not just with the way they looked, the way they were dressed, even their voice changed. So they were talking that whole time, and now they're talking to somebody else, and it didn't register to nearly 50% of those people. That is significant. What is your brain deleting or distorting on a regular basis, and you don't even realize it? So, as I just said, this demonstrates a couple different things. Focusing on one thing may lead to not noticing other things. What aren't you noticing, especially if you have a specific mindset in the markets, or you have your mindset is this has to go up, or this has to go down, or this has to work. If you're focused on only one potential outcome, what else are you not noticing? What else is your brain distorting or deleting or generalizing? Second, your mind can play major tricks on you. If I asked a bunch of you guys, how many of you would, if the person was switched that you were giving directions to, do you think you'd notice? Everybody would say, yeah, of course I'd notice. But in reality, would you really? How many details that changed do you actually notice? How many changes in the environment around you do you notice? What you think you are seeing or doing might not necessarily be what is actually happening. This phenomenon is called change blindness. Now we're going to show you another video to cover change blindness, which you might say, okay, well, I would have been one of those 50% that I would have noticed right away. Let's watch this other video and see other things you might not have noticed.
Clearly, somebody in this room murdered Lord Smythe, who, at precisely 3:34 this afternoon, was brutally bludgeoned to death with a blunt instrument. I want each of you to tell me your whereabouts at precisely the time that this dastardly deed took place.
I was polishing the brass in the master bedroom.
I was buttering his lordship's scones below stairs, sir.
I was planting my petunias in the packing shed.
Constable, arrest Lady Smythe. But how did you know, madam? With any horticulturist will tell you one does not plant petunias until May is out. Take her away. Sorry, madam. It's just a matter of observation. The real question is, how observant were you? Clearly, somebody in this room murdered Lord Smythe, who, at precisely 3:34 this afternoon, was brutally bludgeoned to death with a blunt instrument. I want each of you to tell me your whereabouts at precisely the time that this dastardly deed took place.
I was polishing the brass in the master bedroom.
I was buttering his lordship's scones below stairs, sir.
I was planting my petunias in the packing shed.
Constable, arrest Lady Smythe.
That I find that very fascinating. That was a public service ad that was done by what was just shown, but with the UK, and they have a number of those, and I just find them quite fascinating because it actually shows a number of things. It shows change blindness. It shows that you're so focused on sort of the story, you're so focused on trying to, hey, this is like a mini murder mystery. I'm going to block out things that I don't think is important. Even the guy who was supposedly dead, the body changed. Things like the suit of armor, there's a bear in the back and it changes to a suit of armor. All those things changed. How many of you even caught one of those major changes, let alone all 21? And all those things happened while you were watching the video the first time, which they showed you the second time. I guarantee pretty much anybody listening to this did not catch most of them or even close to the 21. So your brain will only focus on the things you direct it to focus on and ignore or delete things it considers unimportant. If you do not properly direct your brain, providing it a clear set of rules and desired outcomes, then you may be getting different results than you think. You need to clearly define what needs to be focused on and compare it to your results. That's also why, if you don't have that trading plan, if you can't even write out your entry and exit rules, and you don't have them precisely laid out, and you don't know exactly how you take trades, and you're not even giving your brain a set of rules it can possibly follow, how do you know what it's deleting, distorting, and generalizing?
So let's switch back to the actual study of the brain. The evolving brain, a study in behavioral finance. So based on the triune brain theory developed by Paul MacLean, there are 3 distinctive brains that have evolved over millions of years, and Mike mentioned one of them earlier. And that's the reptilian brain, or the lizard brain. The lizard brain controls the body's vital function. It tends to be rigid and compulsive. There's the limbic brain, which is capable of recording memories and behaviors and classifying them as good or bad, and it's responsible for emotions, unconscious judgments that influence our behavior. And there's the neocortex. Neocortex is responsible for development of human language, abstract thought, imagination, and consciousness. It's responsible for learning and development. So those are the 3 types of brain. Go ahead, Mike.
Yeah, and just so everybody knows, the reptilian brain, present in all of us, these other brains have been built on top of it. So the reptilian brain is the core. It's actually the middle, like the middle of a gobstopper, or and then we have the limbic brain built on top of it and the neocortex built on top of it. So it's like layer upon layer of these different 3 major brain functions.
Gobstopper. For many non-emotional decisions in our lives, we use the neocortex section of the brain. For emotional decisions, we use the lower brain to make these decisions. Decisions about fight or flight, risk avoidance, and survival are made by the more basic brain layers, again, the lizard brain. Decisions about money fall into this category and can easily bypass the neocortex. This is one reason that people might know the appropriate thing to do while trading, but their actual behavior is different in the heat of the moment. Think about how many times, whether it's in a Nadex binary product or any other kind of trading you've done, where you were in a trade that you felt strongly before you put the trade on that it was going to go to whatever target you identified, whether it was going to be crude oil going to $40 or the S&P going to 2210, and then as you started to just make a little bit of money, you thought, you know what, I'm just going to take this because I don't want this to turn into a loser. Guess what that is? That's the lizard brain coming in and changing the correct decision. Just like that last line, you might know what the actual correct behavior is, but you change it in the heat of the moment. This is what I was saying in the introduction. These things are not only normal, they're natural. They're actually natural feelings. You're not a failure, you're not a loser, you're not a bad trader, because you're behaving in the way that your brain is trying to demand you to behave. Risk and reward in the lizard brain. Kahneman and Tversky studied people's attitudes towards risk and reward. The study involved giving a group of people a 100% chance of $1,000 or a 50% chance of $2,500. Most people chose the 1,000, even though the mathematical expectation is better for the 50% chance. Giving the same group of people the decision of a 100% probable loss of 1,000 or a 50% chance of losing 2,500, the majority chose the 50% chance, even though the mathematical expectation is better for taking the $1,000 loss. The majority of people treat their decision-making process differently for gains and losses. People will take chances of not losing money versus making money, even though the mathematical expectation is the same in both questions. This is part of it that you might have to look at again. Why would somebody say it's better to take the 100% probable loss of 1,000 over the 50% chance of losing 2,500? That's the lizard brain, telling you, well, I've got a chance of not losing here. Right? So I'm going to take that one. Even though if you end up on the loss side of that ledger, it's way worse.
Yeah, and just so people realize how it works with mathematical expectation, you take that 50% chance times that 2,500, and that comes out to 1,250. So if you were to do that over time, mathematically in the long run, for either the gains or the losses, you'd either make 1,250 or lose 1,250, and the chance for 1,000 is the 100% times 1,000, which works out to 1,000. Just wanted to explain the mathematical expectation.
There's something called present bias. So a lot of you may have heard of NOVA. NOVA is the American Popular Science television series produced by WGBH Boston. They produced a documentary that I recommend everybody watch at some point called Mind Over Money. You can watch it on YouTube. And in that film, they discussed something called present bias that we thought was really interesting. It's right along the same lines. They asked a group of people if they would like to get $100 a year from now or $102 in a year plus 1 day. The vast majority chose the 102 in a year plus 1 day, which is the right choice, financially speaking. When they were interviewing these people, if you watch the documentary, they're like, well, I've already waited a year. I can wait another day for the extra $2. Now they ask those same people, that same group, if they'd like $100 immediately or $102 tomorrow. And the same people that made the financially correct decision made the wrong one and chose $100 immediately. This is a phenomenon called present bias. It's I want it now. Again, going back to the example I said of you have a trade. You expect to make $70 off that trade. And then you look at it and you go, well, I'm up 20. I should just take the 20. $20 is okay. Let me take the 20. One thing Mike and I say a lot is the only time during the process of a trade that you or anybody, any professional trader, any amateur trader, any novice trader, any new trader, is thinking clearly is before you put the trade on. That's when none of the other things are in the way, like the lizard brain is not taking over. A lot of these other stimuli that would normally get in the way of the emotions, they're not in place before you're in the trade. Now, I don't want anyone to take this as us recommending that you never exit a Nadex binary or a Nadex spread early. That is not what we're saying. But what we're saying is if you expected a move to a certain place, and that expectation came, to a certain price I should say, and that expectation came based on a sound, repeatable, and researched strategy. When you feel that lizard brain come in and say, I should just take profits, that's present bias. That's something that scientists are studying. This study that this particular group of people was in Chicago. I will take the small profit I have rather than wait for the larger pre-planned high probability target. That's what present bias is doing in the course of trading. Let's continue on risk reward in the lizard brain. Dr. Burnham, author of Lizard Brains, How to Profit from the New Science of Irrationality, believes this is why people react the way they do when it comes to trading and investing. It's one of the reasons we have market panics and crashes. If you think about crashes, what do the professionals always say? Those are always the best buying opportunities, but what are they developed by? What are they made by? They're made by people selling. The recent conclusions of many of the pioneers into behavioral finance have concluded that the individual who are the most successful at trading, investing, and amassing capital are the same people who have a structure in place to help guard against and avoid making emotional decisions. A trading plan very similar to Trader psychology is one of these sort of buzz phrases out there that you guys hear. It's like, you have to have your plan. Make sure you work on your plan. But nobody ever really expresses to you how important this is. This is the tool to avoid making emotional decisions. This is not something that's like, all right, so guys, make sure you have your trading plan. Let's get started trading. It's not like that. It's not like the sort of obligatory check for a helmet when you're going to go ride your bicycle in a park. Right? Everybody got their helmets? Okay, let's go. This is a real thing you need. A recent MIT study of professional traders came to the same conclusion. The least emotional traders were the most successful. Now, I'm going to add a caveat to that. The ones that controlled what they were feeling in terms of how they acted are the most successful because they're labeled the least emotional. The lizard brain tends to be stubborn and unwilling to accept a loss. It would rather gamble on a smaller or possibly no loss than to accept it is wrong and face a guaranteed loss. Sidebar on that, we try to explain to traders that a losing trade doesn't mean you were wrong. If you go back to the true trader's outlook that we showed you earlier, it's the other probability. If you have a 70% probability trade strategy, in theory, out of 100 trades, you could lose 30 in a row. Can you imagine how emotionally draining that would be? Having a loss doesn't mean you were wrong. Taking a wrong action means you were wrong. The lizard brain hates a loss more than it likes an equal gain, demonstrated by the common coin flip experiment, where the player flips a coin, and if he loses, then he has to pay $5, and if he wins, he will get the jackpot. For the person to take the bet, the jackpot generally has to be 2 to 1 or greater. The lizard brain searches for patterns in random events and makes long-term decisions based on illogical short-term events. What's the phrase we always say, Mike? Making sweeping conclusions from limited data. That's what people tend to do, and that, again, is the lizard brain.
Jump in here for 1 second, Bob.
Yeah.
Just want to explain, again, on this coin flip thing, because what this is really saying is if you're going to do a coin flip and say, okay, if it loses, I have to pay $5. Well, if you could do that over and over again, as long as I were to win, theoretically, $5.01, then mathematically I have a positive expectation. So I could do that infinitely and rack up little bits of money over a long period of time. However, what most people say is they require it to win $10 before they're even willing to take that $5 loss. It's not even rational. They're making on an emotional decision because they picture what that $5 loss will mean to them, and they don't want it, so they're overcompensating by a much larger win than is mathematically required.
Let's talk about emotions versus actions versus emotions. This is one of my favorite sayings that Mike said to me years ago, or put into one of our presentations. You should observe your emotions and control your actions. Controlling your emotion is a no-win situation. I talked about this in the introduction. Attempting to control your emotions only gives your unconscious brain something to push against and doesn't rectify behavior. Attempting to control your emotions can lead to a cascading emotional feedback loop. Emotions that are not beneficial to your trading will diminish through proper repeated action. All those feelings you get about covering trades early or getting out of a loss before it reached the full loss that you had allocated for, those things diminish by forcing yourself to take the repeated action, the repeated correct action. You cannot humanly control your emotion. People are born with different reactive levels. Okay, some people are more emotional, like myself. I get into bar fights, I yell, I cry. And then there's people that are less emotional, like Mike, who I'm sure you can tell just by hearing him talk, is less emotional than me. But we both do the same things when we're trading, is we control our actions. We have different levels of emotional cognition, so to speak. But we both control our actions. It's not about controlling emotions. And the way you do that is by having a written, concrete trading plan that tells you what to do when those emotions are trying to tell you to do something different. You have emotions you don't even feel. You have emotions that you're not even aware of. Same documentary, Mind Over Money. An informal study was done at the University of Chicago. 30 students were asked to bid on a UFC travel coffee mug. It's just a maroon mug with a lid, Nice coffee mug. The average price came in at $6. 6 mugs were then randomly given away to 6 students who were asked to return in an hour. They were given to them free. They said, here, you get one, the rest of you, you're dismissed. Those of you that got a mug, please come back an hour from now. And in an hour, they were asked to write down the price they would sell the mug back to the university for. The average price came in at $9. The emotion of owning the mug for just 1 hour raised the perceived value of the mug by 50%. These people got the mug for free. Theoretically, a penny would have been a good price for it, or at least the price that they would have paid in the first place, right? Well, I was going to buy it for $6, so I'll sell it for $6, right? But no, they had emotion attached to it now. They were personally attached to it. And this happens to you guys with trades. You'll get into trades and you'll think, I don't want this trade to go to a loss because it's my trade. And if this trade goes to a loss, then I'm stupid. You're not. You're not. Unless you did something stupid when you put the trade on. Then you are. And you have to own that. But being attached to a trade, considering one trade to call you a good trader or a bad trader, honestly, it's nonsensical. It doesn't even make sense. But it's what the lizard brain forces you to feel. And you don't even realize it. I'm going to give it back over to Mike for a bit.
All right, so let's get more into specifically the trading plan. Let's see here. All right, so I get the mouse. All right, a trading plan begins to address many of the tricks our brain can play on us. It gives a solid foundation from which to build our trading career. We've been talking about that repeatedly already. Building a trading plan is not a one-time event. So most traders think, okay, I'm going to sit here, I'm going to build my trading plan, I'm going to write it out, and then I'm just going to go execute my trades. And all done. No, that's not the way it works. A lot of traders also say, I don't need to write a trading plan. A lot of traders think they can keep all the trading plan information in their head. If you can't write it down, you can't or won't properly trade it. I'm going to repeat that statement again. If you can't write it down, you can't or won't properly trade it. A lot of people can't even write down their full entry and exit rules. They can't write down. They can say, well, I'm waiting for this to happen or this to happen. I'd like to see this to happen. That's too general. The brain can start feeding a lot of things into that and make you see things that's not there. You have to have a step-by-step process with detailed information. And if you can't write down exactly what you're doing and how you're taking the trades, you can't or won't properly trade it. You won't have a clear set of goals or rules from which to evolve your trading career. A written trading plan establishes concrete information and a solid base from which to generate your own trading feedback loop. So, the most essential part of writing a trading plan is that it establishes the cornerstone from which to grow your trading career. It is only one component out of the 3 that are required. The second component is a trade log, which records all your trades. The third component is a trading journal, which then you use in conjunction with your trade log and your trading plan, and you write down stuff that was going on and emotions and how you felt, and all these things start establishing the 3 pillars that then you can establish a feedback loop. So, what do we mean by a feedback loop? In a system where any kind of transformation occurs, there are inputs and outputs. My background before I went to the trading floors was an engineer, okay? And a feedback loop is part, you learn it in engineering. The system is a series of actions that take place over time which generates the outputs. So it's easier to see graphically. We have inputs going into a system, whatever a system is, and I'm not talking about a trading system necessarily, but there could be inputs into a trading system that produces outputs. It's either trade, no trade, take loss, move, stop. Oh, and this happens over a passage of time. But this could be any system. This could be, inputs into an elevator control system, which determines if it goes up or down, what floor it's stopping on, et cetera, et cetera. And all this happens, again, over a passage of time. So, A feedback loop takes information from the outputs and returns the information back as part of future inputs. There are positive feedback loops and negative feedback loops. So here's the feedback loop part. We take inputs, goes into our system, outputs, and then we take information from the output and we feed it back into the inputs. So here's how a feedback loop works for a trading plan, trading journal, and trading log. So we have our trader, and he or she clearly has their trade setups or entries or exit rules, how much they risk, how they size their positions, everything laid out in their trading plan. They then execute trades based off that trading plan. They write down feedback in their trading journal based off maybe how they were feeling, their emotional, did they follow their trading plan? Did they execute that trade right? They also look at their trade log and go back and then revisit, okay, here's the results of this trade that I executed on this date at this time. Maybe they even take screenshots, which are really helpful to put in a trade log, because then they can go back after the trade's over or maybe a day later and go back and look at really without the emotion of the trade taking place. Did I really do my setup right? Did I move my stop right? Did I execute what was written in my trading plan correctly? Maybe you find you made a mistake in your trading plan the first time you wrote it and you didn't actually write down your steps right. Or maybe you found out that you had a couple losing trades in a row and so you started modifying the trades you were taking. You stopped following your plans. You changed the way you were entering and exits. Completely separate. Well, you're going to notice that in your trading journal. Hey, I had a couple losing trades in a row, and then you're with your trade log, and it did this to my account. Now I started deviating from my plan, or I got really emotional and angry, and I tripled my risk to try to win it all back in one trade, which then turned into another loser. So then I upped my risk even more because I was revenge trading. All these things are going to be feedback loops, but you have to have these components. If you don't track your trades, if you don't write down how you were feeling and what you were doing and what you even noticed, you're not going to remember all these things. And if you don't have a solid foundation of that trading plan, which outlines your clear and concise entries, your exits, your risk rules, how you're going to execute your trades, if you can't put all that down and you can't reference it, especially when the trades are over and say, did I do it right, wrong, you can't establish a feedback loop. And remember, there are positive things and negative things. There are positive feedback loops and negative feedback loops. Positive feedback loops, hey, I did this right. I need to positively reinforce this with myself. I need to keep doing that behavior. Negative feedback loops are things you want to subtract. You want to eliminate. Things that, okay, I felt emotional, I got scared, so I exited the trade early before it hit my stop. All right, so next time, if you've noticed that you're doing that, next time you start feeling that emotion, you're not going to try to stop the emotion. You're going to say, okay, look, I've noticed this. Last time I did this, I exited my trade, or I moved my stop, or I did something that was not my trading plan. I need to physically take my hand off the mouse, take my hand off the keyboard, maybe step back from the computer, do something differently, and over time, this is the repeated action. You're not necessarily going to control that emotion. You're still going to feel those emotions. It's what you do with those emotions that really means something.
Real quick, Mike, there was a trader that I worked with at a company in Chicago. We had our offices in the CME, the old CME building on Wacker Drive. And this guy I finally got him to write a trading plan, and he brought in a shoebox, and he literally would put his shoebox over his mouse every time he felt the urge to do something he wasn't supposed to do, and then he would do push-ups and jumping jacks until the trade, the whole time, even if it was like 3 hours. He'd take a few breaths. He turned into kind of a physical beast, to be honest. But that was his way of dealing with it, is he just put a shoebox over the mouse so that he literally would have to lift the shoebox up. And the main reason he did it, he still made the mistake sometimes, but the main reason he did it was so there was no question about who to blame. He took the box off the mouse. It was his fault.
It's also a pattern interrupt, because if you have to physically take the box off the mouse, it's causing you to become, a lot of times we start acting unconsciously, especially if we trigger the lizard brain. That fight or flight kicks in. We start going, hey, we're not thinking about, we're not using the neocortex anymore. We're just trying to survive. Well, taking a shoebox off a mouse. I know a trader did something similar, recently. He actually he had a wireless mouse. He would take the batteries out. So he'd actually, if he had to do something, he'd have to put the batteries back in. Now, he knew when if his target was going to get hit, he'd start putting the batteries in early, but he'd have to physically take that action. So just that fact, he'd notice himself trying to click on that mouse when the batteries were out, realizing, oh, wait, I'm trying to click on a mouse that has no batteries. Oh, I took the batteries out to prevent myself from trying to do this in the heat of the moment. So then it would interrupt his pattern, and doing that repeatedly started modifying his behavior. That's part of the feedback loop. Let's look at the conscious competence ladder now. We start out at unconscious incompetence, which means we lack knowledge, skill, and ability without conscious awareness of what is lacking. We don't know what we don't know. When you're learning something new, when you're developing a new skill, you don't know what you don't know. You start out at unconscious incompetence, whatever it is. Whether you're learning how to build a birdhouse, you're going to at some point start out at unconscious incompetence. We then move up to conscious incompetence, which means we are now aware that we don't have the proper knowledge, skill, and ability based on experience and feedback. Again, for some reason I chose building a birdhouse. But let's say I grab some wood, grab a saw, and I build a really crappy birdhouse on my first attempt. I now realize I didn't have a set of plans. Maybe I didn't know how to use the saw correctly. Maybe I should have used glue instead of nails. Whatever it is, I get some feedback, and I have to learn something. So this is where I might need to build that trading plan or the plan to build the birdhouse. I might have to get the correct tools, whatever that is. We then go to conscious competence, which is deliberate application of knowledge, skill, and ability gained from consistent effort over time. There's that time component again, and it's consistent effort. We don't go from conscious incompetence to conscious competence right away. We have a feedback loop between this. You realize, okay, I did this right, I didn't do this right. My next birdhouse is better than the first one. My third birdhouse is better. Or, hey, this entry and exit rules really don't work for me, but this one I found really does work for me, so I'm going to keep that in my plan. I'm going to get rid of the other one. And I finally then realized maybe why I was not doing well with the other one. Maybe I was trading on too short a time frame that didn't match my personality, too long a time frame. That's part of the going from conscious incompetence to conscious competence. We then eventually, over a period of time, get to unconscious competence, which is application of knowledge, skill, and ability without conscious awareness. The skills are second nature. To get from conscious competence to unconscious competence takes another feedback loop, and it's taking the correct repeated action over time, and then it becomes unconscious. You no longer have to think about it. You no longer try to reach over and get out of that trade early. You no longer adjust your target or stop because you're feeling some emotion. It's now built into you that you've taken the correct action repeatedly over and over again, that it's now part of your unconscious. The wrong question. Many people, when attempting to change or modify a behavior, focus on the wrong question. People ask the question, why? Why did this happen to me? Why did I have a losing trade? Why am I not making money? The challenge with asking the why question is it triggers a fear-based emotional sections of the brain. It looks for things to blame. It looks to make it personal. It looks to make, oh, what's wrong with me? What is going on with me? It triggers emotional aspects. Asking why generally presupposes that the questioner is attempting to assign blame to something or someone, including themselves. Or, why did I lose my, oh, it's the market's fault. Or those gosh darn market makers. Or those high frequency traders. Or those, or whatever it is. They're asking why. It's putting the responsibility outside of themselves and also triggering the emotional aspects. And if you repeatedly trigger the emotional aspects, the brain will start reacting and reinforcing that emotion, and then it won't be diminishing it. It can actually grow over time. The correct questions. Let's see. The better question to ask is the what question. This focuses the brain on the problem-solving areas and leads to refocusing the brain on actually solving the problem. So we have the W-cube method of questioning, which is something that I came up with years ago, which is what's working, what's not, and what am I going to do about it? Not why did this happen, not do I have another losing trade, why is my account going in the wrong direction, why did the market do this? It's what's working. It's a feedback loop. What's not? What's working we want to look at and use that positive feedback loop. What's not? Those are the things. Maybe I need to put the shoebox over the mouse and try to interrupt that pattern. What am I going to do about it? That's coming up. Maybe I need to learn more things about this. Maybe I need to talk to other traders who have solved this problem. Maybe I need to look some more into trading psychology. Maybe I learned that my current, because I didn't have a trading plan and then I wrote one down, I really don't have a viable trading method. That's learning something. That's part of the feedback loop. That's saying what's working, what's not, what am I going to do about it? First of all, that takes responsibility and puts it on the person instead of putting it external. It diminishes the emotion because now you're looking at it. You're actually using the neocortex and trying to shift it away from the emotional and lizard brain aspect. Once you know what, you can focus on the next steps. Why does not give you any next steps. It doesn't matter if you know why. What steps do you get to take from why? You still have to figure out what are the next steps. What's working, what's not, what am I going to do about it? So,
real quick, Mike, if I could. It's just one of my favorite stories about what versus why. When I was at on an FX desk at a German bank years ago, and my responsibility was the sterling US dollar. That was the pair that I covered, that I sold to other banks and traded with. And I remember one day specifically, I tell this story all the time. There was about a 600 pip move, 640, something like that, on a Friday afternoon, all at once. And it happened in the course of like 3 hours. And that was a pretty big move for the sterling Japanese yen. It was in the sterling Japanese yen pair. And that was a very, very big move for that particular pair at that particular time. Japan's been closed for a long time. They're not reopening. It's their weekend. Why is this particular pair moving? London's getting ready to go to the pub. Why is it moving? And all these guys kept saying, why is this happening? Call around, find out why this is moving like this. You know, is the BOJ involved? Is the Bank of England doing something? Is George Soros trying to corner this market? You know, we need to know why it's moving so fast. And they called around, and eventually they all came to the conclusion that the Bank of England must be doing something in the market. And it didn't really affect me that much. You know, I was sterling related, so I was close to those guys, but I wasn't trading it. A few hours later, I got a call from a friend of mine at Lloyd's of London, and he asked me if I saw that particular move in that particular currency. And I said, of course I did. The desk was going crazy about it. I said, you know, why did it move so fast? What was behind it, right? And he said to me that there was a sushi chain in Tokyo, in Japan, called Sushi Boy Sushi, loose translation. And they were exchanging a bunch of yen for sterling because they were going to expand their operations in London, and they needed to hire staff and managers next week, so they wanted to get the jump on exchanging some currencies. This explains the futility of why. Because if I had turned to these traders and told them, I know why this is happening, it's Sushi Boy Sushi. First of all, what kind of economic conclusion can be garnered from a sushi chain exchanging yen for sterling in order to expand operations? Does that mean the economy's growing, shrinking? Does that mean interest rates are changing? No, it's just a transaction. Number one. Number two, they were all acting on the incorrect why. They all came up with whatever made them feel better. And really the why they were looking for was the why that didn't force them to cover losing positions. That's what they were looking for. They were looking for an explanation that allowed them to stay in their bad trades, something that made sense for them. And it goes back to what Mike was talking about earlier, where you can start to ignore things and all of the data around you will now start to confirm what you hoped was the truth. So this is why we talk about why being futile. Why my why when I do interviews on TV is based off of what? Because I don't care why a market is moving. I only care what I'm going to do about it, if anything. Maybe I do nothing. But my plan tells me when I have to do things and what I have to do, and nothing else. It doesn't tell me why a market's moving.
Tied it all the way around. You completed a feedback loop, tying it into the way you started off. I liked it. So, using the W cubed questions, establish the feedback loop with your. What's working is a positive feedback loop. What's not working, negative feedback loop. What am I going to do about it? Those are modifications required to generate output closer to desired results. The combination of your executed trades in conjunction with your trading journal will enable you to modify your trading plan over time and figure out what's working, what's not, and what are you going to do about it.
So quick summary, and I know, we always stick around for questions, and we're happy to do that again, but I know the first question we always get after we do this presentation is, can you guys teach me how to do a trading plan? Do you have a template for a trading plan? And one of the things we've tried to do with Path Trading Partners is not to lure you guys into buying something, so the answer right now is no. Okay, you're going to have to actually work on it and do some research and things, and what we're really trying to get across from you is the things in this summary and the things in this conclusion. In this webinar, you learned you can't hit a target you can't see. We investigated some of the ways your brain can fool you. Again, you're not stupid. This is natural. This is nature. You're fighting nature. Being a trader isn't necessarily instinctive. Okay, when you're walking down the street and you feel pain in your foot, you take your shoe off, you pull the rock out, you throw it away, and you keep walking. Trading is not like that. With trading, you have to accept pain as a complementary probability to the pleasure. We learned about the concept of feedback loops. We learned about the ladder of consciousness. And finally, we studied the concept of W squared and the power of the what question, which we talked quite.
Bob, I think your sound just cut out because I can't hear you anymore.
Am I back?
Yes.
All right. You heard the summary?
Yes.
I want to make sure you guys heard the summary.
Hear the conclusion.
Your psychology is critical in order to be successful as a trader. Some people are born with an ability to manage it, but most are not. The most calm person can lose it while trading. It's not about you having a calm personality. It really isn't. The best cure for this problem is a pre-planned and repeatable logical action. You need pre-planned and repeatable logical actions. And you can only hope to do this with a trading plan. One of the examples we give all the time is if you think you can actually trade your plan correctly without writing it down and having it in front of you, how many times have you gone to the grocery store, walked around without a list, only to come home and realize you forgot something? Sometimes you forgot the main thing you went for. That happens to everybody. If you can't do it with a grocery list, how are you supposed to do it with all of the different factors that go into strategies, that go into trading strategies? This is why when people try to sell you boxed up strategies, they're so popular with you. Because you think, well, I don't really have to do anything. I just open the box and trade the strategy. And a lot of the times those strategies don't take into consideration the tens of thousands of things that can happen. Even with a boxed strategy, you need your own trading plan as to the amount of risk you're going to take, and the times you're going to trade, and the time you're going to wake up, and the emotion you were feeling while you were trading. And if a dog was barking in the background, that's actually a true story. A trader that I trained in that same Chicago firm I mentioned earlier in the Merck, in the CME building, he decided he was going to move out to California. So he asked me if he could trade from home 3 days a week before he moved, and I said okay. And he did just fine. But the days that he was home, he started losing money, and we couldn't figure out why. So we went through his trade log, right? And he had repeatedly written, my dog is driving me crazy. My dog is barking and driving me crazy. So he started putting the dog in a different room. And when he moved to California, he left the dog in the house and turned his garage into his trading room so that he couldn't hear the dog barking. It was affecting what he was doing. And there was no way that that could happen without a trading plan. Whenever we have a student that's been successful come back to us and state they've fallen back into losses, it is almost always because they stopped using their plan or they stopped modifying their plan. They said, I know it now. Now I know everything. I don't have to read my plan anymore, and I don't have to use it. Don't make that mistake. Okay, start off by writing a plan, put everything in it. There was a slide in here that described what you need in your plan, and start looking at your plan, and remember, it's a living document. It is the only solution to trading psychology. It's not hypnosis, it's not meditation, it's not, I'm not going to say some of the other stuff that are popping in my head. A plan is the only short-term solution because you can't control emotions tomorrow. You can only control your actions starting tomorrow. Happy to take questions if you've got any. Rich says he thinks he's got about 6 questions. If you feel like typing them, Rich, I'm happy to answer with them. Otherwise, you can just email us at support@pathtradingpartners.com. Or you can go through Nadex if you want. They'll get us anything if you don't find us. But here, I forgot to put this up, and I guess I should. We get into this subject, and we lose the idea that we're actually supposed to be, we have a company that's supposed to help you guys, but we just get into the idea of helping you guys. And really, if you join us at Path Trading Partners, there's a lot of stuff on there that you can do for free. Listen to our podcast, The Money Path, which we actually do quite a bit of psychological discussion in there. Okay? And like us on Facebook if you could. Follow us at @path_Twitter, @path_trading on Twitter. So most of the stuff that's going in is basically people saying it was a great presentation, which I just said again, I'm not going to read, but I just did. So, again,
think you do that every week.
I do that almost every time. I do it almost every time. I say, thanks for telling us we're great, but I don't want to read that. And I read it. Thanks for that, Gary. Look, guys, Mind Over Money is on Nova. It's about an hour long. You can watch it on YouTube. Watch that, and you'll start to get some of the things. You'll start to see some of the things that you do. Okay, because it's some of the things that I did. Watch this presentation again. It'll be up on Nadex. Just go to Nadex under Education, go to Webinars, go to Archive, and it'll be up there sometime in the next day or so. It'll be up there. You can watch this over and over again. Or we'll put the link at pathtradingpartners.com. Again, do us a favor. Join pathtradingpartners.com and sign up for our podcast because you'll hear a lot of this kind of stuff. All right, we'd really love to see you guys on the podcast. All right, again, I'm not seeing any questions, so we're going to go ahead and let you guys go hit the bar or the espresso bar or whatever it is you need to hit. And cheers, everybody. Thanks again for being here. Thanks to Nadex. We'll see you guys next Tuesday.
Thank you.